Well, welcome back. You are watching On Point, and as Nzinga mentioned, there definitely a different setting coming to you from our Sea Point studios in Cape Town. Nonetheless, time to check in on those markets. The tech stocks bringing the broader Hong Kong index a little bit lower against the backdrop of mixed Asian performance. It's the strong jobs report from Friday that has brought a stronger case of perhaps even more aggressive Fed tightening. Traders now saying that the odds of a 75 basis point hike in the Fed's September meeting is greater now. The Nikkei up about 0.25%, and the Hang Seng index in negative territory, closing lower at 0.7%. It's the US CPI figures for Wednesday that will be center stage this week, giving us some perspective on the Fed's policy path. When we look at the Rand right now, bringing it locally, 1667. Brent currently at around $94. We're around just below $90, again restrained by the global demand outlook. However, to give us some perspective and, of course, look at some of the elements that we can expect for the week, we are joined by Bright Kamala from Vestec Asset Management. Bright, thank you so much for your time. Looking at the JSE right now, I mean, what's your sense of how we're performing given the fact that we saw Asian markets a bit mixed, European markets as well? A bit of an interesting perspective when you look at the performance there, but how's our JSE holding up?
Look, the JSE is holding up just fine. I mean, the whole of Southeast Asia didn't do bad by itself except for Hong Kong. I mean, if you look at South Korean markets, you look at Japan, you look at mainland China, all of those did exceptionally well. So I think we continue on that route. The JSE is up 0.2%. Resources are bouncing back finally. Even I think everything's in the green here, man. Industrials, financials, everything in the green. Looking at the top 40, we have Impala, which is up 4.2%, Sibanye up 4%, Northern up 3.3%. In the losers, we still have losers. Unfortunately, we have things like BHP Group, which is the old BHP Billiton, down about 1.8%. Glencore down 1.7%. Mediclinic down about 0.6% there. So there are some companies in the red.
So you look at the jobs report from Friday and you look at various news articles, financial media that is reporting on those figures. What does the jobs report figure mean for the Fed, given the fact that they're going to be, data dependent and forward guidance is not necessarily a thing right now?
I don't know, man. The number came at 528,000 jobs that were added in July, which means, all of those losses we saw in the wake of COVID, that's all been recouped now, and the unemployment rate is at around 3.5%, matching a half-century low that we last saw last year, 2020 February. So basically, we're back at quote-unquote full employment in the US. And which is remarkable if you have to think about it. And obviously, what it means, for the Federal Reserve is that, they should continue, their path of increasing interest rates to try to curb the inflation you've seen. But what's interesting about this 528,000 jobs added, it was twice the amount that, economists had forecasted. So that says a lot about forecasting, to say the least.
I mean, what kind of sectors does one then look at in an inflationary environment, especially if you're not having a trader mentality and you're thinking long term? What do you bear in mind here?
I think you'd want to focus, obviously, within companies with great pricing power. I look at late cycle sort of players like LVMH, Kering Group, even our own, Richmond here, and those type of businesses have great, pricing power, and their clientele tends to be the top 1%, and it's by design. It's not a feature, so it's by design that they do this. And obviously, you want to be in businesses that can actually pass on the inflation, to their customers. And these businesses, I think, they'll hold up during an inflation environment.
Shifting gears slightly, I mean, you look at credit spreads that are appearing quite calm right now. What's that signaling to you?
Look, I don't look at credit spreads. I don't know much about, the credit business and what it means. But if I had to look at what the market is telling me, is that, we currently, back in, risk-on environment. Sentiment is sort of positive across, even in Asia, it's starting to turn positive as well. It's turned positive, definitely. I mean, if you look at the past months returns, we've had 3 weeks of amazing growth, as people are swapping from sort of value stocks back into growth stocks. If that's what the market is telling me, I guess we're back in risk on.
Okay, on that note then, I mean, if you had to take stock of U.S. earnings season, especially the companies that Vestec has, a hold in their portfolio, I mean, what do you make of some of the executives' guidance going forward? I mean, did it meet your expectations? Anything caught you by surprise?
I was quite surprised that technology continues to actually grow, even though, most of the pricing that we saw, for example, mid-June, basically the market was telling us that, we should be fearful of what's to come in terms of earnings. But earnings season sort of, show that these companies are very resilient, and hence maybe the 3-week rally that we're seeing in these growth stocks. And obviously this is good for Vestec and Vestec clients. It's been a decent 3 weeks. In terms of, trying to read too much into earnings, I think we should take these things at face value and not try to forecast too much what's going to happen in the next 18 months. But right now, I think I like where the market is. There's still a lot of opportunities, especially if you're a stock picker. It's still going to be a stock picker's market for the next 18 months, I'll say.
Which is a nice segue into my next question, because we're now about to sort of kick off our local results season. And going into U.S. earnings season, everybody was looking at what inflation had in terms of company earnings. What are you going to be paying attention to when our local results season starts really ramping up? What's the key for you?
Look, I'm going to look at some indicators. For example, we're expecting mining production data to come out on Thursday, also manufacturing production data to come out on Thursday as well. I mean, if you looked at mining for the month of the month of May, we had a decline of 7.8%, which is not good for our economy. Flood-induced issues that we've seen in our local economy also led to manufacturing production going down about 7.6% in April. So I don't know, man. It doesn't look well for our local economy, and as a result, you shouldn't expect, SA Inc., especially SA Inc. companies, except for financials, to actually perform really well in the wake of this. But I'd love, as a South African, I'd love to see the economy turning somewhat. But I mean, with load shedding and all that's happening on the ground locally, it's hard to stay positive. But I try as an optimist to stay positive.
All right, well, let's leave it there. Thank you so much for your time. That is Brad Kamala from Vestec Asset Management. Well, we will continue with our markets coverage on Wednesday, where we look at what the upcoming US CPI print will mean for the dollar. That is it from me.